It's a really good topic, Dave, and I've had some issues with some real estate agents who are wondering, what is warrantability? What does it mean? What's the difference? Mike, in plain English, if I'm a new real estate agent and I come to you and said, hey, Mike, I'm trying to help my client with this condo over here. It says it's non-warrantable. What does that mean? And can you help? What would you say to that real estate agent?
So we see that all the time. And part of the problem, to Dave's point, is there's a lot of companies and folks out there that just don't know how it works. And so they might be passing on a good deal because technically online it says it's non-warrantable, where we can do a loan all day long with normal down payments, normal loan, all those things if we just do a little digging. But if they are not at a company that is able to do that, like a lot of normal retail shops, they can't do it. They can't touch it. But whereas we can, and so we see that stuff all the time. And so the main thing we start looking at is, are there health and safety issues? If we can get past those, usually we can find a way to get around it with a little digging and some things like that and get a person a normal loan on the place. And we see that stuff all the time. But the problem is, especially first-time home buyers, whatever, they're relying on all these folks they're talking with to give them the proper knowledge, and those folks might not have the right knowledge. And if you don't know who to go to, you don't know, folks like us or whatever that have the experience to deal with those things, man, they're kind of stuck and they're missing out on deals. And
Dave,
so, man, you gotta keep
Dave,
digging and all the true rate guys.
yeah,
It's all as simple as that. So.
absolutely. So the bottom line is, just because it's non-warrantable, it doesn't mean you can't get a loan on it. And many lenders will tell you, let's not even look at that one because you can't get a loan. What that lender is really saying is, I can't do the loan. But some guys like Mike and Dave and Tim over at True Rate, they can do it.
Yeah,
Dave,
I get this call all the time for some non-warrantable stuff, and it's
especially in the mountains, the ski towns. I see that a lot.
What's that? Yeah, ton up there. But even here in Denver, there's a ton of them. And so I get this call all the time from other agents. They're like, hey, we're having trouble with this condo and my lender can't get it done, but I see you were able to get it done. What'd you do?
Right.
And I'm like, well, I'm not going to teach your lender how to do their job. So if you want to do the deal for it, I'm happy to help you, but I'm not going to give you the secret sauce.
Right.
I get that call all the time.
Dave, FHA, you talk about FHA approved. Can you break down FHA approved condo versus warrantable? What's the difference in plain English for somebody brand new to understanding this?
Yeah, so it's I think this is where, warrantability gets thrown around as a very broad label. Technically speaking, we have to check the warrantability for that specific loan option, right? So if it's going to be an FHA loan, we need to make sure that that project is HUD approved. Likewise, if it's going to be a conventional loan, we have to make sure it fits Fannie and Freddie, condo approval guidelines, VA, et cetera. Now, the interesting thing, right, with HUD is you can do what's called a spot approval. So if it's not approved, we can still get that project approved during the transaction. But in that scenario, HUD is still looking at the project directly, and they do have slightly different requirements than Freddie Mac and Fannie Mae do. We actually have a deal under contract right now that's owner occupied. The property had been sitting because they had a note that, it was potentially unwarrantable because the investor ownership percentage of that entire project was greater than 50%. That's okay as far as Fannie Mae and Freddie Mac are concerned. It's not okay for FHA, right? So in that scenario, it wouldn't be warrantable to do an FHA loan, but it's completely warrantable to do a conventional loan. The other thing that's interesting too is we also see it reversed, right? Sometimes we see a property approved for FHA financing, and it might be approved on the HUD website as an approved project. But people also have to be mindful is we do see now with FHA loans on the rise, if there's more than a 10% concentration of FHA loans in that project, you can't do another FHA loan. FHA won't allow that because they've got a cap on the allowed concentration of FHA loans in that project. So there's a lot of potential pitfalls out there. So to your point, it is somewhat difficult for, professionals outside of our lane per se to know all of these details. But again, those are just a few examples where we've seen situations where something might be marketed as warrantable for an FHA loan and we find out it is not, or vice versa, it's being marketed as non-warrantable for a conventional and we find out it is. So again, it's to Mike's point, it's just really important that people have somebody on their team and on their side that can kind of do that research for them and help identify those things as early as possible in the process.
That's a great point. One thing I've noticed is that a certain number of listings out there, condo listings, are actually incorrectly labeled. They'll say this project is, something or non-warrantable or not FHA approved, and we'll check it out, and actually it is. So not only are the rules tricky, but you really need to work with a lender who has the tools to do the sophisticated background checks to really see, can the loan get done? Because 9 out of 10 times we can do the loans that everybody else says you can't on these projects, and that's a shame.
Yeah.
I want to move right into refi revolution. I'm seeing quite a few refis come through the pipeline right now, and I don't know why that is. I've got a couple cash out refinances, and I think that goes without saying. People have kind of run out of money or patience, and they are now looking for some money to pay off bills, maybe do some expansion. People are done waiting, I think, for this rate thing to come down to a point, and I think people are just biting the bullet. I had a borrower who was at a 7.5%, and he wanted some cash. He needed cash badly. His home needed some work. We are able to refinance him down 0.5% and get him, 50 some $1,000s out. To him, that was beautiful, because even though the payment's only going to change by $100 or so, getting that money and just the sanity of knowing he broke out of that 7.5 rate was worth it. I'm seeing some refinance activity. Are you guys seeing that as well? Tell me what it looks like on your end.
Yeah, we're seeing it quite a bit as well. I think the hard thing for most folks is they're in the opposite scenario. They still have that 3% rate they got back in 2000 or 21, whatever, and they're trying to hang on to it. And I get it, man. It's an awesome rate. You're never going to see it again, but they're trying to hang on to it. But the last few years, life's expensive and it's not getting any cheaper. And I think they're almost to the breaking point where they're just like, man, I got to do something. And yeah, we might take their rate from 3% to 6.5 or whatever the number. You might double that rate. But if you look at the overall picture, you're taking their entire cash flow and reducing that. And so, like when you go into the grocery store, they don't say, hey, you owe me 7%. They say you owe me $87 and whatever, right? And so you got to break this down into a dollar. And so if we can't, even though we might be bumping the rate, but I'm lowering your monthly cash flow by $1,000 a month, you might sleep better. It might get you moving in the right direction for sure. And so it's definitely something to think about. And it's just critical, again, to know your numbers.
Dave, who's the borrower who should not do a refinance right now? What comes to mind? I mean, you get people calling you all the time. Hey, what should I do? People trust you. You've had clients for 2 decades. Who's the borrower who you just say, hey, look, hold tight for a little bit. This doesn't make sense for you. Give me an example of that.
Yeah, I think, I mean, the easiest target, I think, in that scenario is somebody that's looking to leverage their equity that doesn't have an existing second lien. Second liens have become very popular, right? Whether it's a fixed rate installment second or a HELOC. We're starting to see scenarios where some of these HELOC might be the same or even a larger balance than the first mortgage.
Wow.
Well, if you look at those blended payments and blended rates, right? I mean, if you've got a $200,000 HELOC, are you really going to be able to pay that off, in a relatively short term? Probably not. So does it make more sense to, take those HELOC rates that are at, 7 plus, wrap it in with your mortgage, and let's say you can get that rate down in that 6% range? Those folks that have, noticeably larger second liens on the property, they probably do want to, consider the idea, or at least look at the numbers on a refinance. Now, on the very flip side of that, let's say you're not in that category, right? And let's say you're in that position where you owe 200,000 on your first mortgage and your rate's at 2.5, and you're looking to take out, 40 or $50,000 for some home improvements. Well, in that scenario, a second lien position could probably make sense, because what if you could put that 40 or 50,000, on a fixed rate term? Let's say you could do it as a 10 or a 15-year term, get that paid off, get both those mortgages paid off in relatively the same window, et cetera. So I think the folks that are looking for, relatively smaller cash out amounts and they don't have a current second lien on the property, those are the people that might want to consider some of those alternative options other than just diving into a cash out refi.
Yeah, you brought up a HELOC. HELOCs are pretty popular as well. I have a couple of those rolling as well. We offer several different HELOC options. Mike, is there a HELOC that you seem to that your clients tend to be more attracted to right now? Tell me about that product, if you can think of it.
And There's all kinds of different HELOCs. And so again, it's all about educating the borrower on here's the positives and negatives of each one. So if they need cash fast, well then we go to one of the automated HELOCs where they'll have funds in 5 days. It's simple. Just it's all automated, it just rolls. But if they have more time, we can do a more traditional one where they are giving us their tax returns and pay stubs and normal underwriting, a little bit more of the normal process, and that could take 2, 3 weeks, but that might have a better rate because it's a little more labor intensive. So it's just you kind of have to match up with, all right, if I'm willing to jump through all these hoops, I'll get a better deal. If I want fewer hoops, a little more expensive, what works best for them? So it's just kind of showing them the options and let them choose what makes the most sense for them.
Anything going on? I want to jump into the regulation roundup. Dave, this is your hot spot here. Anything new in compliance that you're seeing? I know that this is a really broad question, and we get busy. We don't really, well, you read guidelines, I think, regularly. But anything new in the world of, even with the NAR settlement, have you guys heard anything new there? Anything at all? Anything going on with compliance?
I wouldn't say anything new necessarily. It's just be mindful of that current environment at all times. Now, it's interesting and specific concerns to the NAR settlement is, I think what consumers have to understand, right, is real estate is regulated primarily on a state basis, not necessarily at a federal level. Now, if you go back and look at some of those details, if there were states that were fixing prices, well, that obviously is an issue, right? And if you've got price fixing going on and it's really removing the negotiation away from buyer and seller, then yes, I mean, you probably need regulation to step in on, more of a federal level. Now, I'm sure you guys have noticed the same here, but specifically here in our state in Colorado, it was always negotiable, right? Because on that Colorado contract to buy and sell real estate on, that bottom section, it always specifies who's paying what commissions. Is it coming from the buyer? Is it coming from the seller? So on and so forth. That's always kind of been a dynamic necessarily here in our state. So, I think to some regard, it's probably been relatively business as usual from, what I've seen on the outside looking in. And, perhaps you guys have seen the same.
Yeah, I mean, I haven't really noticed a whole lot. I was worried when the NAR settlement came into play. I was worried about the negotiation and all the confusion and the pushback there was always, like usual, a lot more fear out there about what was going to happen. I really haven't noticed any, and none of my realtor partners that I'm aware of have really seen a difference in business as usual. Have your realtors noticed anything different on that, Mike, with the NAR?
No, I agree. I haven't really. It was,
They
everyone
figured it
was
out, didn't
freaking
they?
out for a while, and then not a whole lot has happened. We see an occasional deal here or there that it comes up. I think Dave had a deal where the buyers needed to pay it, but he was able to rework the numbers based on how we can do that on our side to get the realtor commission paid, and it was really no big deal. Another benefit of how we're able to restructure stuff with where we're at. But other than that, I think it's almost a non-issue.
That is a huge, huge point. If you are a realtor and you run into a situation where the numbers aren't working because the buyer doesn't have the money to pay that cost themselves, we have the flexibility to try to make that work as much as anybody. And everything we talked about this last time, or I talked about it a couple of meetings ago, it all points to margin. Everything, every benefit, everything that we do as a mortgage company all goes back to margin. We cost less. There's more money on the table for us to help everybody. I think that applies to us. I think that applies to every successful company that has smart profit and loss balance sheets. Well, I think that's it for today, guys. I'm going to jump real quick into rates one last time, and you're not going to like this question, but we're going to do it anyway. When are we going to see that first Fed rate cut? And don't worry, I know I will elaborate in a second, but what's your prediction? I won't hold you to it. Give me a window of when we might see the first Fed rate cut. Go ahead, Mike.
Oh, I was hoping Dave was going to go first. Come on. I was going to piggyback on him. I think we are getting close to the tariff thing kind of calming down. And so if we have that calm down just a little bit, we could see, I don't know if they're going to adjust it here
Okay.
the next session or not. I bet you at best case, they might, the last meeting of the year,
Okay. So
they might reduce it, which in reality won't have very little impact on rates in
yeah,
reality.
all signs of Jerome Powell are pointing to waiting for the labor market to cool. It does
Yeah.
not seem like he's in a hurry, but I will tell you, in watching Jerome closely, and I have studied this guy like a psychopath, he always sets up the opposite. I've seen it 3 times now where he's played it down, played it down, played it down, played it down, and then in October it came with a whammy of a cut out of the blue. Granted, that was already priced into the market, so nothing really happened, if you guys remember. So I don't know. I'm gonna go ahead, Dave. Save me here. What do you think? When are we gonna see the first rate cut? What needs to happen for the first rate cut? And by the way, we realize that the Fed cuts are not mortgage rate cuts. The Fed is cutting overnight bank to bank money. That's totally different than mortgage rates. However, it can impact mortgage rates pretty quickly. That said, Dave, talk to me.
Yeah, I'm going to take the very conservative answer here and say I don't know. This is probably the most uncertain, right? We've seen markets perform economically in recent history. And obviously, uncertainty just adds some, speculation that things may get strung out longer than anticipated. I think one of the interesting things, though, that, isn't always talked about is, the Fed has been in this quantitative tightening position since we got on the other side of COVID. And that's been going on for quite some time right now. It'll be interesting to see if there's any talk of loosening that or even getting back into quantitative easing, because I think what is important for consumers to realize, right, is it's not necessarily what the Fed does in short-term rates that's going to impact them on their mortgage rates. It's really what's happening in terms of the bond market reacting to the markets. And yes, they're correlated, right? The bond market is going to react to what the Fed does and rate cuts and so on and so forth. But if we do see some quantitative easing, and let's say, for example, maybe the Fed begins reinvesting dividends in, mortgage-backed securities or treasuries they already hold, or let's say they start buying up more slowly but surely. I mean, that it can ease bond prices, and that, would have a bigger potential impact to what a consumer would see in terms of mortgage rates. So I think it's going to be interesting to see how that plays out as the year goes on. But I think consumers need to be mindful of that. A Fed short-term rate cut may or may not do anything for them in terms of long-term rates. So just be mindful of that as a consumer. Because Tim, to your point, that's really just impacting liquidity within the banking industry on how funds are being exchanged and so on and so forth. It doesn't necessarily trickle down to the consumer.
Yep.
So again, consumers be mindful of that. If we do see the Fed, for example, cut rates 0.25%, yeah, it's probably going to help your auto loans, credit cards, and HELOCs. It may not change anything to long-term mortgage rates. So just, again, have that expectation that rates may continue to remain relatively constant in this 30-year and 15-year fixed environment, regardless of the Fed decision here.
Headlines move markets. And you brought up a good point, and what you said is 100% true. Rates may not change very much, but here's what happens when a headline says Fed cuts rates. Fed cuts rates a quarter, an eighth, whatever the cut is. Here's what happens. People call you. People call me. People call us. We give them the rate quote that is the same as it was before that. And all of a sudden, I talked to Tim today. It was a Fed rate cut. It's 6.625. Yeah, that's what it is. Oh, wow, that's really good. Actually, that's what it was. Nothing happened. It was cooked into the market 4 months prior. Yeah. The point is it's a psychological game. People are emotionally charged 90% and then 10% rationally charged. I really firmly believe that. That is why I think, bringing back to Jerome Powell and his actions, I think his job is a really tough job because he cannot show emotion and he cannot be reactive. Like every day, that guy has a big board in his room that says, don't be reactive today. Don't be emotional. If you watch the guy talk, Dave, you'd be if you could take his job, you don't show emotion. Jerome's job is to make us believe, and he's real good at it, and it's probably true, is to show us that he is not going to do what anybody tells him to do. He's going to do what's right fiscally for the economy. For that, I respect him. So I'll shut up here in a minute, but here's what I think needs to happen. I think people need to quit expecting and begging for it and get used to it like we're starting to see it. And right when everybody's used to it and nobody's begging for it, Jerome's going to turn the key and go. Quantitative easing button, go. Bond buying, we're going to buy a little, go. And we're going to cut a little, go. And that, I really think that's when it happens. When that happens, my prediction is Q3 of this year. End of Q3. Football season, we got big games. the smell of, like the leaves burning, like that's when it's going to happen.
The smell of leaves
I
burning
hope
and
you're right.
rates dropping is what you're
The
saying.
smell of rates burning and leaves dropping. No. Well, that's it for Good Mortgage America. Thank you, Dave. Thank you, Mike. Appreciate you guys' time. We'll be back next week and hopefully with some more good information. Thank you guys for joining. Have an awesome day. Appreciate you.